What's going on, family? It's Sean. The layoffs continue. Continue historically high numbers. And recently, household debt has gotten over $16 trillion this second quarter as the New York Fed just released their quarterly report on household debt and credit. So let's go ahead and jump into this. So today, the news came out that Robinhood, which is a financial services company, got very large during the pandemic. There was a lot of liquidity, a lot of easy money was going around. Student loans had shut down, which, they're still, those payments are still shut down, but people had a lot of money to speculate. So Robinhood benefited from that. Well, it doesn't look like that's going to continue to happen. Today, online brokerage Robinhood announced that it's cutting 23% of its staff. With the CEO citing that a drop in trading activity, high inflation, and a broad crypto market crash. This move comes after Robinhood laid off 9% of its full-time employees in April. And as the CEO says, those layoffs didn't go far enough. And also yesterday, there was a report from Oracle that they were going to be beginning to start laying off people. They have an estimated workforce of 143,000 employees. The news isn't out yet because no CEO wants to immediately address those questions. That's something they kind of want to, get out there slowly, maybe put everybody on a Zoom meeting and say deuces to you. The other thing that came out today, because we've been seeing these layoffs and we've been seeing them, I'm sure you're going to see more in the financial sector. You've seen them in crypto, seen them in tech forces. I believe in July, at least 30,000 tech sector employees had lost their jobs. But at the same time as that's going on, we are in a historically tight and strong labor market as far as demand for employees, availability. There's about 2 jobs for every 1 person looking for a job, which, could be great news. There is some issues as far as participation rate. But overall, when you look at those numbers, it looks great. But the New York Fed released their quarterly report on household debt and credit. So household debt and credit has ballooned to over $16 trillion in the second quarter. Now, the breakdown of this debt, over $207 billion of this debt was mortgages. $33 billion of this was auto loans. Now, the mortgage debt and the auto loan debt, you see that dramatic increase most consistently because the prices of homes and of vehicles have risen so much. So those people are taking on more debt because those prices have ballooned. Actually, the debt, the prices for autos and mortgages for those loans has increased over 36% if we take it back to 2019. But the most startling thing about this most recent report was the increase in credit card debt. So credit card debt increased $46 billion. Now, this increase of credit card debt is the highest increase in credit card debt since 1999. So what the New York Fed, what they're finding out, which is obvious, is that a lot of this credit card debt is because everything higher in price. So people are eating those costs. When they don't have the money, they're putting it on credit. Their food's up, cars up, your home's up, your power's up. You need to use credit. A lot of people aren't in that position. But what they also said in this report, so you can go to this website, read this report. They also did a blog post. They also said that they're seeing most of the increase in what they consider to be their higher credit score borrowers, which I think it's I understand we have to use a metric to gauge people and say if they're credit worthy. But I know several people who have a high credit score that I wouldn't trust giving them $1. All right. Because I'm never going to get that money back. but they are saying they put a positive slant on it where they're saying like, oh, look, there's this huge increase of credit card debt, the highest rate of change, the highest that we've seen, this $46 billion since 1999. But don't worry, all the people who are taking out the debt are responsible and going to pay it back. Yeah, I'll believe that when I see it. Uh, Lastly, I kind of wanted to go over just how strange this current environment is. So you're seeing those layoffs, but you're not seeing them at historical highs like you did for the Great Recession. I was reading an article by Wolf Richter. He writes Wolf Street. It's a great blog. You should check it out. I'll put a link in the description. And he was just kind of talking about the economy because we are in a tight labor market. You heard Jerome Powell speak a week ago talking about, of course, you've heard leadership talk about that. We're not in recession because historically, when you look at the job openings numbers and the labor market, it's strong. Okay, even though that we did print two back-to-back consecutive quarters of negative GDP growth. But I was reading Wolf Richter's blog, and he was talking about how, in comparison to the great financial crisis, the layoffs are minimal. Also, it's the quit rate. So people jumping from job to job, they track it by what they call quits. So the number of workers who voluntarily quit jobs in June dipped for the third month in a row to 4.24 million, but was still up by 20% from the already very high levels in June 2019. This huge number of quits largely reflects job hopping by workers who are trying to get a better job, aggressive hiring by companies, and a massive churn in the labor force, where workers can leverage the large number of open positions to obtain higher pay and better working conditions. So I know several people who, as this pandemic happened, after lockdowns happened, they kind of changed their perspective on life. I'm less, I'm more risk adverse, but they've been hopping job to job, or they're looking for something, which everybody has that right to do. And it looks like people are still doing that currently. But remember, this data is going to come on in a lagging effect. So the way that it usually works with job losses is a slowdown in hiring. You'll see a hiring freeze, and then that's when the layoffs begin. But currently, where we're really seeing the layoffs are in those tech companies, those financial sector companies. I did see there does look to be like there's going to be some issues with manufacturing as things are slowing down. Wolf Richter was also saying that there is still aggressive hiring. So the private sector employees hired 5.96 million workers in June. It's down from May, but it's up 9.5% from June 2019. So there's still a lot of that money sloshing around in the economy. We had all those PPP loans that went out. Consumers are generally, there was a lot of government assistance, which has stopped, and people feel wealthier because, one thing is people haven't been paying student loans, and gosh, I don't know how it's been a long time, and that the average student loan, I believe, is about $467. Let's just round it up to $500. You have another $500 in your pocket. Of course, things went up, but if you got, some help, or, you were already doing okay financially, or you were one of those people who got a decent enough pay raise or had been making enough, people can still feel, that I can leave my job. I can find something else. I have a little bit of wiggle room. Maybe they have a little bit of savings, or they can take something temporarily. So it's very interesting how we're seeing this market. I do believe that we're going to continue to see more and more layoffs. The construction field right now, the job openings for construction dropped by about 71,000. It's the second month in a row of declines from the record in April. which was of 334,000 openings, but it's still up. Construction job openings are still up 7%. And that's, that is a sign of what is going on with the economy if construction job openings are falling, because there is news coming out about builders, stopping projects, or I know where I'm at specifically right now. I have seen builders look towards, where they were going to build single family homes. Now they're looking into building townhomes because I think they'll get a little bit more bang for their buck with the material prices, and they're seeing that decrease in demand that's going to come. But I don't know, business as usual. They're trying to tell us everything's all right, but that credit card debt says otherwise. $16 trillion in household debt is a lot. It's Irving Fisher wrote in his debt deflation theory of money, over indebtedness is the largest factor when it comes as far as causing a depression. And we know our government's in debt, our households are in debt. They continue to tell us that it's okay though, because we have stronger balance sheets. They've loaned out money to more credit-worthy borrowers. That's all of that sounds good. It all sounds good until there really is this slowdown, which we're seeing through the GDP numbers, the negative growth numbers. Because you can only afford to pay for things, these 10-year car loans and these heavily inflated housing prices, depending on where you live, if you have the proper and necessary cash flow and you have your job, or you have a way to make money or a way to get money. And that means there needs to be, growth and a high velocity of money for you to be able to get those dollars to pay off those debts. So I just want to give you all a quick update. It's a strange time that we're living in. Just to recap, debt continues to increase. Layoffs seem to be increasing, but we're still in a strong and tight labor market, and they're telling us that the power is with the job seekers. So we'll see. I have a feeling things are, probably going to turn for the worse, but I'll keep up on it. I'll catch you on the next one. Take care.